Good afternoon and welcome to the Wealth Stewards Mid-Year 2026 Town Hall meeting. My name is Jeff Breese and I will kick us off into our town hall today with not only sharing a little bit of an update on the firm, but also our agenda, as well as some interesting accolades and awards for the last quarter that we and Concurrent, our back office partner, have earned. Before I do that, let me tell you that I am coming to you live from the Wealth Stewards East office. It's a beautiful environment here south of Boston, where as of February, we have expanded our presence to the East Coast, fully functional with the team here, including Grace and Amanda, and we're open for business. So if you have anybody that you're thinking of that might be a little bit further away from the home office hub of the Wealth Stewards in Scottsdale, Arizona, we're here to serve. Let's jump into today. Obviously, I'm already here giving you your welcome and these opening remarks, so we can check the box on that. I'll follow up next with some firm updates and some awards. And then Brent will come in. I'll transition over to him for a market update and a recap of the most recent market activity. And then finally, Cyrus will come in to introduce you all to the Stewardship Academy, which is our platform that we partnered with to help prepare the next generation for their financial journey. So let's jump into the firm updates. And it's great news. First of all, you can see that our own Brent Mekosh, my business partner, has been named an Advisor of the Year with Alternative Investments by Investment News. Now, what does this mean? Well, it means Brent got to go to New York City, dress up in a fancy tuxedo, but then also be awarded with this honor. We're so proud of Brent. He's been diligent the last several years in expanding our ability to offer alternatives to our client base and to new clients that have come on board. So congratulations, Brent. Second, Concurrent Investment Advisors, who we partnered with as our back office when we made the journey over to the current iteration of the Wealth Stewards 2 years ago, has been named the NASDAQ RIA Firm of the Year. I can't overstate this, folks. There are thousands of registered investment advisory firms here in the United States. And for Concurrent, our partner, to be named #1 in that category is mind-blowing to us. It's a testament to the work of the people that we're partnered with and work alongside every day in the home office, out in the field, and then our peers who have also joined us in Concurrent Investment Advisors. So we're really excited about that honor for Concurrent because we've seen how hard they've worked on our behalf and yours for the last several years. And then in addition to that, not only is it the #1 RIA firm, but it's also been named by Investment News as one of the best places to work. We've seen that again as we've done the work the last several years in their growth and their expansion of their staff, how everybody is welcomed, valued, and is part of the journey of the growth story of Concurrent Investment Advisors. So these three updates are things that we're very excited about, not only for us, for Brent, but also for Concurrent Investment Advisors, who's a key part of helping us serve you all. With that, my firm updates are done, and I'm very excited to transition over to my business partner, my good friend, Brent Mekosh. Brent, take it away.
Hey, Jeff, thank you. I really appreciate all those updates, and it's great to see you joining us from TWS East back in Massachusetts. You did get back here last month, but we've missed you here in Arizona over the summer. You've missed some absolutely delightful weather, but we look forward to seeing you back here in a couple of weeks. So let's dig into the markets and take a look at what we're seeing as we moved into the third quarter. So if you recall, these were our 2026 themes. If you've joined us for prior town halls, this is what we've been operating under as we ended last year and moved into this year in terms of our key themes for the year. Now here we are halfway through the year, and they all still feel really relevant. You know, first theme, let's talk about the AI playbook. Of course, AI is a major driver, not just in the markets, but across the entire economy. This is no longer a future story. Both Jeff and Ryan and Cyrus and myself and Denise and Kayla, we're all involved in different entrepreneur organizations, and the amount of disruption that is coming from AI is really unbelievable. So the question becomes, you know, how can we leverage this internally as a firm, and also what actually makes a prudent investment? And that's something we've actively considered during every investment committee meeting. We're way aware of it, we're watching it closely, and it's definitely driving some of our decisions, no question about that. The second is navigating valuations. Valuations across some sectors of the market are definitely elevated, but it really depends on where you look. There are some areas where, that are very tightly linked to this AI story that we just discussed that got really expensive toward last year. And actually, as we've come into this year, have gotten somewhat slightly less expensive, I should say. Other parts of the market still offer reasonable, in some cases, very attractive entry points. We've made some very meaningful changes to our portfolios over the past year or so based on this. The valuation really for us is critical. And we're going to walk through a few of those with you. The third is the noise resistance. This was a big one coming into this year, and we never could have had any idea the kind of noise that we'd be dealing with. You simply cannot turn on the television without finding something to be concerned about. We've got politics, we've got military operations, geopolitics more broadly, there's monetary policy, you name it. But underneath all that noise, corporate America is actually doing quite well. Earnings are up pretty much across the board, regardless of what sector we're looking at. The consumer has proven to be a lot more resilient than a lot of people expected, and the economy continues to move forward. Interesting, the inflation number came out this morning just before I recorded this, and it was a little bit cooler than anybody expected. Our long-term investment decisions, really, they can't be dominated by getting pulled into every news story. We have to stay anchored to what's actually working and look at the best places to be investing money. Let's move on to the next slide. So, diversification, it's almost a cliche to say in this business that diversification matters, but it really does. And so what's working this year? This chart's a really good illustration of why diversification matters and why some of the changes we've made over the last year or two have really been important. Let's take a look at, for example, at the end of June. Emerging markets are up about 24% as an asset class as of the tail end of June. 3 years ago, back in our Raymond James days, we really didn't have any meaningful emerging markets exposure. And we're actually grateful for that because at the time, emerging markets had not done much for well over 10 years. This year, on the heels of a great year last year, emerging markets are up about 24%. US small caps, right behind them at about 23%. Mid caps, large cap value, international stocks have all delivered solid double digits returns so far this year. And meanwhile, the S&P is doing fine, but large cap growth, which had previously been a major driver, is only up about 5% so far this year. And now look at the Magnificent Seven: Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, Tesla. As a group, they were actually negative year to date at the end of Q2. That's really different picture than what we saw in 2023 into 2024 and 2025. And that's really mattered for us this year because we talked last year about that concentration risk, and we really wanted to do the best that we could to pull that out of the portfolios. And that did impact a couple of the portfolio decisions that we made this year. Early in 2026, we made a deliberate tilt away from growth and added more of a value bias across our client portfolios. That's turned out to be a good decision so far. Now, the second decision that we made was reducing that concentration risk that I just referenced. We spent a lot of time last year. It was one of our core themes, talking about the historic degree of concentration among those biggest names that made up the S&P 500. And the amount of money that poured into those 7 names in 2024 and 2025 reached unprecedented levels. This year, those names have been lagging. Broad diversification into some of the more underappreciated asset classes over the last few years has really helped. Portfolio decision number 3 that we made back in 2025 was international stocks. Back then, if you recall, it was one of our main talking points last year that we wanted to do a meaningful tilt in international, and we did, and it was a big part of return last year. International outperformed domestic stocks last year. They're outperforming again this year, and we still think there's plenty of room for this to continue. International valuations remain significantly more attractive than what we see across U.S. markets, and typically, when these cycles start, meaning when you start to see international outperform U.S. assets, it tends to last for several years. It tends to be a longer cycle. Now, I'm going to give you in this slide kind of a key example of what we're talking about where we continue to find value. This chart shows the relative price to earnings ratio of the S&P 600, that's the small cap index, versus the S&P 500 going back to 2006, 20 plus years of data here. As you see, that number goes down. That means small cap stocks get cheap, just put simply. And small cap stocks, as they've gotten cheaper and cheaper, they haven't been a great place to be for quite some time. Really until this year. This year, they're starting to show some life. And they remain, even though they've had a good year so far, at historically undervalued levels relative to large cap stocks. And that valuation gap is the primary reason we made a move to pivot in the small caps to a greater degree back in January. We pulled dollars out of our mid cap exposure and also our large cap exposure and increased our small cap exposure. That's been a pretty good place to be this year, and it's definitely helped drive returns. Now, we couldn't do the town hall and not talk about SpaceX. This is a different kind of market noise than what you're seeing on the news. At least you're seeing it on the financial news. You're not seeing it on the broader news. So let's talk about the SpaceX IPO. We didn't invest in it, but I thought the whole episode was really interesting on a couple levels. First, on a personal level, my son is obsessed with rocket ships. The whole space thing is absolutely huge in our house. So during the day, I get calls from clients saying, "Hey, are we looking at buying SpaceX? Are we going to buy SpaceX?" And then I go home. My son would say to me, he'd say, "Daddy, we're going to buy some SpaceX." The answer was no across the board. Look, SpaceX is a really exciting company. It has the potential to change a lot of things. But at the end of day, valuation really matters. And I think the SpaceX IPO is a great example of media hype versus what the real numbers kind of are on the ground. So let's look at what this thing was valued at, because I just think this is a phenomenal thing to look at. It's a fun exercise to walk through as well. This chart puts the valuation into context. When SpaceX went public, it was trading at roughly 94 times sales. Not 94 times earnings, 94 times sales. They weren't making any money. So 94 times sales is an absolutely astronomical number. We've never seen anything like it. For comparison, Meta, which was Facebook then and Meta today, when it went public in 2012, it was considered to be one of the most expensive IPOs in history at about 28 times sales. So that's like 30% of SpaceX's valuation when they came out. Now, as a key reference point here, the S&P 500 trades at roughly 3.5 times sales. So SpaceX was extremely valued by any historical standard. Now, I'm not saying this company is not going to be amazing or that it can't grow into that valuation in a long enough time horizon. But when something is priced this far ahead of current fundamentals, the margin for error gets very small, and the probability of significant volatility is very, very high. So let's take a look at that. This is a cool chart as well. This is kind of a chart of the quarter for me, at least around SpaceX IPO. When we watched SpaceX trade, it opened at around $150 a share, rocketed up to $220 a share. And as I'm recording this, it's back down lower than it first traded. It's at $138 a share. It's been a crazy ride already, and it hasn't even been that long of a trading period so far. But this chart, you may not be able to read it, but you're seeing a lot of red, and that's really the important thing here. It gives you an idea of how a lot of these big, very high-profile IPOs trade in the first year or so. Remember, I just mentioned Meta, Facebook. It was a really hot IPO, but the first year of being an investor after Facebook came public, it didn't go particularly well. Stock had a maximum drawdown in year one of 55% of where it traded on the first day. And it finished the year roughly down 31%. Now, Meta's had a great ride since then, so I'm not taking anything away from the company, but it shows that price really matters. And that experience is actually pretty consistent with what we've seen across a lot of high-profile IPOs over the last couple of decades. So looking at this table again, I hope you can read it, but there's a lot of big names here. What it shows is the median one-year return after the first day close for these big IPOs is down about 31%. The median maximum drawdown is about 53%, which means that actually Meta, Facebook, was pretty average in terms of how it traded in year one. Now, what SpaceX is going to do is anybody's guess, but that's what some of these big names tend to do in year one. Now, some names have done really well, Palantir, Airbnb, for example. But the list of stocks that were down 40, 50, 60% or more in the first year is really long. So value does ultimately matter. Even great companies can experience very large drawdowns when they go public at these extremely elevated valuations. And that was the lens we used during the SpaceX IPO. And that's why we kind of stayed back and we just didn't get actively engaged in it. And so far, anyway, it's been the right decision, at least in the short term. Now, what it means for SpaceX in the long term, I can't say, but we've got to have some discipline around valuation, and that has served us well here. And with that, speaking of more education, I'm going to hand this over to Cyrus. He's going to talk about education and something we're really excited about here at the Wealth Stewards, the TWS Stewardship Academy. So Cyrus, on to you.
Thanks, Brent. Always love hearing your perspective. Next, I'd like to talk about something very near to my heart. As a former math teacher and someone who's taught financial literacy in multiple different classrooms, education has always been something I've been extremely passionate about. On behalf of the Wealth Stewards, I'm so excited to introduce a new program we're rolling out for families called TWS Stewardship Academy. Stewardship is a big part of the Wealth Stewards. Heck, it's in our name. And when we think about stewardship, we don't just want to think about managing investments, building estate plans, or helping families make smart tax decisions. Those things are important, but true stewardship also means helping prepare the next generation for the responsibility that comes with money. You may have heard the term shirt sleeves to shirt sleeves in 3 generations. It's the idea that wealth is often created in one generation, maintained for a time, but then lost by the third. What's interesting is that wealth rarely disappears simply because of bad markets or poor investments. More often, it breaks down to a lack of communication, unclear expectations, and heirs who inherit wealth without the knowledge, context, or confidence to manage it well. One famous example is Cornelius Vanderbilt, the Commodore, who was born in 1794. He was an absolutely ruthless businessman. He built a massive transportation empire, including the New York Central Railroad. The only substantial philanthropic donation he made was $1 million to establish Vanderbilt University, the Commodores, in 1873. At the time of his death in 1877, he was the wealthiest person in the United States and had a fortune that exceeded $100 million, which was at the time 1/9 of the US currency. Within 30 years, no member of his family was among the richest people in the United States. And in fact, 96 years later, in 1973, Vanderbilt University invited 120 of his descendants to the school. Not one of them was a millionaire. And that's really the heart behind TWS Stewardship Academy. We believe that one of the most important questions that successful families ask is not just, will this money last, but how will this wealth impact the people I care about most? Our goal with this program is to help answer that question in a practical, approachable way. TWS Stewardship Academy is designed primarily for high school and college age students to help them learn real life financial skills rarely taught in the classroom. The program covers topics like goal setting, budgeting, saving, spending, credit, investing, insurance, taxes, and what it means to be a thoughtful steward of the resources they have. Now, this isn't meant to feel like school. There is no homework. We release 1 chapter each week. Each chapter should take no more than 30 minutes. And the goal here is to keep it simple, practical, and easy for our students to engage with on their own time. Ultimately, we want the next generation to build the knowledge, habits, and confidence to make better financial decisions as they prepare for the future. Because preparing the wealth for the next generation is just part of the work. We also want to help prepare the next generation for the wealth. What you see here is the homepage once students log in, and we've partnered with Jedediah Collins, author of The Money Vehicle, to make this available. In fact, here's a short video from Jed.
How do you make your paycheck go to work for you? This was a question I asked myself almost 20 years ago. How's it going? My name's Jedediah Collins. I am the founder here at Money Vehicle. I'm also a former NFL player, certified financial planner, and your fullback of finance. But that question, my first paycheck, how was I going to use it? How was I going to make it work for me? Was something that really struck home. I had no idea. I didn't speak the language of money. That was the origin in the start of Money Vehicle. I, being my first student, had to translate this language to an avenue and a place where I understood it and would apply it. Money Vehicle is that program. It is the step-by-step guide to not only educate, but also empower you to capture your dream. That is by making money go to work for you and putting your paycheck into a place where you are sure your plan is heading in the right direction. I could not be more excited to partner with the Wealth Stewards, truly an organization and human beings that are dedicated to guiding you in this financial journey. We're going to use Money Vehicle to introduce topics, to understand better, but they will always be your steward and guide as you have more questions around the actions you are going to be challenged to take on this journey. Money Vehicle is the start of a conversation to empower you to speak the language of money and begin to see money as the vehicle to take you where you want to go.
Thank you. And here are just a few screenshots from the program where each section will have a brief video or two along with just a short quiz at the end. Let me actually show you what the program looks like so you can get a feel for what the student would see when they log in. As you can see, there's a lot of material here on this scroll bar, but each section will be released weekly in small amounts that they can digest. We will have access to who sees it, who's keeping up with it, and who isn't, and we'll be able to be their guide through the TWS stewardship journey. So if you or someone you know that's part of the Wealth Stewards family would benefit from this, please reach out to us, provide us with their name and email, or better yet, an email introduction so we can say hi, introduce ourselves as their financial guide on this journey, and get them set up on TWS Stewardship Academy.
And that concludes our town hall for this quarter. We appreciate you taking the time to join us and for your continued trust in our team. As always, if you have questions about any of the topics discussed today, please reach out to your advisor. They'd love to hear from you. We look forward to seeing you again in October. Have a great day.